All right, ladies and gentlemen, I hope you're having a wonderful day. It was a crazy day in the stock market. There was the tariffs, the bond yields, the inversion of the yield curve, but we're not going to talk about that. I want to go over trading strategy. We have the whole weekend to go over the news. We're going to be streaming on Sunday, and we're going to be live Monday, so we got a lot to talk about, but I want to go over, simply I got something for you guys. It's very, very simple. We always win. I'm going to go over 3 steps to really turn a losing trade into a winning trade, and why I made a trade today, and it was pretty confusing for some people, but it's a way to never lose the trade, and I'm going to explain it through here. And if you guys have been watching this account and you've been watching these trades here so far, you remember this exact same Apple play. I was down $6,000. So that wasn't too long ago, but now I'm up $1,000 on the position. So if you think about that, that's a $7,000 swing so far. And then there was other plays that we made even with the insurance and the other options. So this was selling premium and then buying options. So even what I'm going to discuss, it has to do with options, but the first 2 steps you could use even if you're trading stocks. So I'm excited to go over this, and hopefully you guys will see what happens. The aspect here is protection. So I'm going to go over the trades, and if you guys remember, we logged this, last we edited it was April 30th. So I was down on this play for the earnings, but remember the whole aspect was I was trying to protect the position I was down on. So even though it is kind of ironic I'm saying protection, but what led me to being down $6,000? I was making a trade, and you could say impatience, the timing of it. I did violate the rules, and it led to this. However, I violated the rules that got me in this mess, but I was still able to use the same principles we're going to talk about here to get me out of it. But, I had to use a lot more money, and I had to be a lot more patient. When I opened this first trade, it was on February 1st, and now we're hitting June. So that is the fee or the tax, you could say, of being impatient when it comes to either, both premium selling and buying your options. The, timing is very important. We've been stressing that on the stream a lot as we've been trading, and you could see it as a reflection through here and even this other premium sells we've done. But I got taxed for being impatient, selling too early, selling too big, and that is what led me to, wait so long to get a profit when, if I did this around the same time, if I waited even till before earnings or after earnings, I didn't have to hold for 2 months and be down on it, and I didn't have to tie up that capital. I could have just waited, and I would have been able to make more money. And, I think about the $7,000 swing, I could have made a lot more. So let's get into it. I'll break it down for you guys. We always win. That is the point of trying to make plays and setting your guys' trading up. You want to not lose money. Even when we were talking about the Robinhood and everything, you want to not lose money. Try to protect it. I didn't even do good on the Robinhood, but I'm doing a lot better here on the bigger amounts. But with it comes to everything you want to do with setting up your plays, even a general trading strategy, extend things out over time so that you play the longer term game. If you're going after quick flips, just keep this in mind. Go small. You're not that tight. So what we mean by that, on your first trade, you're making a trade, don't be overconfident. The market doesn't care what you think. You want to make a trade, always enter in small on the first thought or idea. It doesn't matter what research you've done, but by going small with the options, you're able to, give yourself room to do number 2, which is average down. I'll give you guys the rest. And then last one's sell premium. But you want to average down. By going small, you're giving yourself room to work with. If you're wrong, it doesn't hurt you. If you're right, especially if you're trading options, or even if you, as you saw with the Soli play, even if you're day trading, even if you go small and you play the right type of move, you're still walking away with a gain that's, more than acceptable, more than above average. So if you just constantly do that, and that's the whole point here, consistency. And, with this account in trading, we went over these statements. It's over 92% success rate. And I told you guys, people were thinking we were going to lose on this. We didn't. We always win, and it happens for a reason. It's both understanding what you're playing in the options, but also setting it up with the strategy. Even if you don't know anything about trading options, if you even have a general approach, you're going to do better than a lot of people who know a lot about options, but they're just arbitrarily buying and not having any strategy associated with it. So by going small, it allows you to have room. Now, I kind of did that here on this opening trade. The first trade I sold for $2,400, and honestly, I've sold, that Amazon I did it for $1,000, which isn't that small. This was kind of small, but not really, because I sold a lot of contracts. So I had a lot of time, but I sold a lot of them quantity, which put me at a little bit more risk for the gain to accumulate faster when it really started to go against me. It was in the money at one point. And if you aren't familiar here, it says -4 Apple calls because I shorted the contract. So even in the portfolio, this is selling premium. So that was even the third thing here, because that is the trade. That's the trade that I made in today, lock in the gains and kind of create a ghetto spread. You guys are going to see here, but we'll go through the trades and the winning trades. And then, this relates to what the move I made today. This was one of my insurance premiums, and here I have these June 7th 165 puts on Apple, and now I'm holding 5 of these. I had 20 or 25 at one point, but I sold them off at much higher prices to take my profits at earlier dates, and I wanted to hold these to still, try to get some of the gains on the downside. But now they're coming into a week. The contracts are very vulnerable to, the time decay, especially if Apple doesn't go down or even stays the same. God forbid it goes even up, it would kill these contracts. So it was risky. And again, I'm trying to get my money back. And, I was this is all part of the strategy we're going to go over here. But I want to make sure I'm getting my capital and money back. So I paid $170 for this trade. I'm up 160 in profit. So it's worth like $420 or something around there. But my original initial investment was $170. So what I did today, because I still want to hold it and I still think it could go down, but I was worrisome. I was thinking about cutting it, but I still want exposure. This goes down to the philosophy of always winning. I bought these contracts, so I make money. It's a 165 put. If Apple goes below 165, I will make money. Or even if it comes down there and there's still time, I could profit off of extrinsic value, hopefully. So I own those contracts. They're worth $300-$400 for 5 of them. I paid $170. So what I did today, I sold $160, so $5 lower. I sold 5 of them, and I sold them for 30 cents or something, but I pretty much collected $175 total. So by selling them, I shorted them. I went short on the contract, meaning I think Apple will go up, or pretty much I'm saying by this expiration date in the next 7 days, these contracts will be worthless, because if these contracts are going to be worthless, these contracts will probably be worthless too. But again, that's my worry. That's why I wanted to sell them today. However, I still thought Apple could go down. So by doing this, I collect $175 on it. So I make $175 in cash. That's how much I paid as far as the initial trade went. So pretty much I'm break even and I walk away with $5. If it does expire worthless, I'll lose the $160 in profit. But again, I'm willing to let that ride. But now here's the kicker. If it does go down, let's say Apple does drop to 160. The best part is these are 165s and I have 5 contracts. So $5 a share on 5 contracts, that's $2,500 in profit. Before these would even start, I would be down on these, but I would make $2,500 on these. So even then, I still could make $2,500 before these even become vulnerable. And even then, I still could walk away with not losing on this play. So that's the whole point of becoming a win-win. So that's not to mention the whole aspect. Again, I was down 7,000 with this play, but this is, a little way you could see it to explain number 3 of selling premium to lock in the gain. So by being up on it, I sold premium. It's literally risk management. It's protected no matter what, because even if it does plummet to 0, I'm protected by these puts I own. So I will still walk away with a profit, believe it or not. No matter what happens, the whole concept here is now, if it bounces up, I'll make my 175, I'll lose my profit, and yeah, sure, I'll lose this, but that would have been the original outcome if I tried to hold it on the downside anyway. So what did I do? You have to understand there was a cost to it. I gave up my gain. So this put, I could make more money. Let's say it did drop to 160, I would have made a lot more money, but instead now by selling the 160, by selling it, if it did go to 160, anything past 160 is canceled out by the loss on this one. So I capped my max potential gain. However, I did limit my potential loss. So that's how, by selling premium, again, and understanding options and strategies like this, that's why I'm trying to show you guys a mix of all this on the channel. And again, some people, you don't need that much to sell premium, but you could do this, and think about this. You could even do this with monthlies and weeklies at big plays. Intel, I sold a put today on them, and it cost me about $400. You needed a $400 account to do that. But again, even with options and any sort of margin, I think the recommended amount, save up, get like $2,000. But again, you could go either or. But selling premium, again, you're going to make less money on this, and you have to have a lot of strategy and know how these things operate. But these are simply the three things you need to do. Go small so you could have room, and that's exactly what we did here. All these plays too, I did go small. So even if you go down to this play, here's when I bought those. I bought them on April 30th. I got 25 of these 165s, and I bought them for 34 cents. So they're still, again, as you see, that's why they're up double, but I spent $850. And now, as we even go through this trade, if you guys, now let's, I think that's appropriate to talk about. Let's go through now how we turn this $7,000 one, and you can see, why do I have these? And even then, it says I have a loss because that's what these plays are. So if you guys remember the story, I was down $6,000 on this play. And then, this was coming in even into earnings. So prior to earnings, I was down $6,000. So I wanted to protect myself to now minimize the loss. I held this play from February up until the earnings, and that was right, that April-ish when we started to actually make moves, the second trade, April 29th, right before earnings. And you could see now, again, I did this in practice. You guys saw me do this over time. I sold these for $2,400. That's, again, the initial premium. So I shorted these contracts. I said I agreed to give people 400 shares of Apple at $215 a share by the end of June 19th, 2020. So I had a lot of time. I collected $2,480. That's the max gain. So come April 29th now, a few months later, those same contracts, they were up a lot. The contracts each went to $1,600 because I sold one. So this is where the loss occurs. Each of those contracts is at $1,685 a pop. I shorted 4 of them, so I sold 4 of them in February for $2,500, but now they're going for $6,740. So that's actually not, I guess I was down. So minus that from 2,480, I was unrealized 4,002. So I think I was down 7,000 on it when the play was going against me, but then the insurance actually saved me for a little. But it's ironic what happened there. Pretty much now I was down, and I waited till April 29th, and now this was averaging down. So now with premium, this made sense. On options now, with what we say with options, even explain number one a little bit better too. If you even went small with the contract, the whole idea is that by going small, you could enter in a play. Let's say you buy a crappy contract that expires in a month. You could go on buy it out of the money, a cheap one. Even then, again, know what you're buying. But even if it goes down now, by going small, you could even let that contract expire, and instead of averaging down, you move to a better contract at a different date or whatever. Even think Boeing, I had weeklies expired today. I have the next week's, but now by going in small and going in little by little by little, you could track the stock over time, and you just go small and then adjust with the dates as they expire, especially if it's a slow mover and the stock hasn't moved or you're anticipating something. So that's the whole point of going small. But now with premium, I average down because instead of getting to a different strike, I wanted to take advantage of how much the contracts became. So I sold 4 of them for $6.20, thinking they would go down, and they shot up to $16.85. But this is what I was saying in the beginning. I was impatient. The contracts weren't, they were at a weird middle point. They shot up. I wanted to try. I was trying to get a gain, and I was up on these at one point at like $200, and I didn't take the profit. But I and then I got stuck in it, and I was down. But that's the whole point too. When you become down on premium, how many of you guys remember? You guys could comment below. How many of you told me to cut my losses, or how many of you at least remember people saying, "Oh, take your losses, take your losses." The odds were in my favor with the premium, believe it or not. And now some people, again, I did this with Boeing before, and now the easiest thing to say, I love it because I totally agree with anybody who says it. I got completely lucky. I'm with you. I did. It shot up on me. Think about it. I sold the calls here in February. Again, the market was doing nothing. I could have profited off of nothing. Then it just shot up on me. But people are saying, oh, it dropped because of the trade war. Well, actually, they had good earnings. Then there was the trade war stuff, but we're going to say trade war, whatever. They said the same thing with Boeing, but the whole point is by selling time and premium, the strategy behind that with having a lot of time, you could account for any random event. You could fill in the blank. Sure, you can get lucky, but by selling time, you give yourself time to get lucky. So that's a pretty that's a pretty important part of the play, but it came up now. The contract was really expensive. It had time. They go up in value. So what did I do now? I averaged down. By averaging down, I sold the same contract. So I was -4. I sold one more, but this time now I collected $16.85. So I sold 4 contracts and I got $2,400 total. I could take the same exact risk. I was already down, so I'm getting crushed. Even if it did go up, I was going to get hit no matter what. So I could literally just add another $100 per share if it gets in the money, whoop-de-doo. Let's do it. I had the buying power. We were set up. I was ready to take the pain. And then again, too, the next day I even got insurance, but I collected on that $16.85. So at first I had 2,480. That was my max gain. I'm already down $4,700 at that point. So what do? I average down, and I collect another $16.85. So now I have 4,165 potential gain, and that's what you see here, trade price. That's how much I've collected so far in premium. That is my max gain. So next what I do is I start buying calls. I buy on April 30th. I buy the 210 calls and the 212s, and that's what you guys I'm still holding them, and these actually were up a couple $1,000s, but I didn't take profit on them. But this is the main point, even going over the trade, we could fast forward. But after going through, again, I'm down on this trade. And just like I did with this play by capping my gains and losses, that's what I was trying to do here. So these were 215 calls that expired in 2 years. I was going to lose if Apple went up. And even if it went in the money, I would lose dollar per dollar on now five contracts. So every dollar Apple went up, I was going to lose $500. So what did I do? I bought shorter duration calls. These had time, this was April. I bought them with 2 months out. I got 212.15. So by buying contracts here, even if it did rip up, it saved me some of the pain. So by 212.15, if it did go to 215, I would be making $2.50 per share intrinsic value. And then I got these 220s because saying even if it did rip up and if it did shoot up, there would be implied volatility. I got more contracts to protect it. But then I also bought other calls. I bought now 210s and 220s. So now in this case too, I had those 212s and I got the 210s with even more time and then closer to the money. So I would have made $1,500 on these before I would have started losing money. So again, I was down 4,000. I could have made 4,000 total. I would have been down now like 6,000 at that point. But I was going to say, if it went up, I bought these calls to mitigate the loss. But then I also bought puts too, to say if it did go down by buying some of these contracts, I was looking at how much. Now the whole key is noticing the outlay, and that's what I said. And I said purchased options, so max loss. So I calculated any option I bought and didn't sell premium on, that means I could lose money on it, because as you see, if I don't sell them out, they're going to become worthless. So I calculate those into factor in my cost basis, and that's why I only collected 4,000. I was down 5,000. So again, you have to think at that point, even though I'm down that much money, there's a big swing, but there's also a max gain. So at the end of the day, I spent $3,000 in options. I could lose that. So again, if the stock did nothing, I could lose my premium here. So that was a risk. So then what did I do? I also sold another out of the money further on the 2020 and collected $1,000. So that brought up my max gain to around like $5,000 now, and I spent $3,000 on premium. But now the whole point with all of this trade, to make it a win-win, my point I'm trying to tell you to focus on by breaking it down. A lot of people, you could look at your individual trades. I made money here, I lost money. Look at how much money came out of the account, how much money comes in. It makes it a lot easier. Even with understanding this play that I did today, it's how much money did I spend initially to buy this, how much is it worth now, and then again, I got this money back. So this money came out of my account initially. If this expires because it's a bought option, I lose that money and the profit. But now by putting that money back in with this play and then understanding the concept that no, it's a logical conclusion. If this, then that. If this expires worthless, then this has to expire worthless. There's no other choice. So if that's the case, all my money's back in my account. And that's the whole point of looking at my inlay and outlay. So now you could see, let's go over the trade history. So there was that last premium sell. And then as you see here, and then I spent $300 more. I did a little straddle, I think. Did I get calls on it? I think I did calls. Those were supposed to be puts, not calls. But here's the first after the earnings on May 13th. Now, remember, I bought 165 puts. Those were insurance. So I sold these now. And again, here's all we need to factor in is how much money did I get? I was out there. So when I bought any insurance plays on the play, I put $3,400 out there to ensure the total max gain. So we want to know how much money now is coming back when I'm selling options. This is to manage the position and keep an overall P&L and know what's happening. So I got 990 back I sold the 165s on that date for 110 each. I sold 9 of them. I got 990, and then I sold one more for 110. So plus 110. We're 1100 is back in the account. We'll ignore these plays for now because those were not even this was after the earnings again with the initial premium. I think I was gambling on those. Then we got these. These are those June 7th. Those are the ones that I made the play on today. So again, you guys see I have 5 of these left. My hand is in the cookie jar. These are worth $500 now. They're at 60 cents a pop. Coming back to May 20th, really that's like what, 11 days ago? They were going for $1.30 each. So this is, again, noticing the optimal time. And we've been talking about that even in the stream alerts and on stream, the optimal time to sell because of time premium. And that's why I even did the move I did. But I sold out 10 of them for $130. So again, I had 20 or something of them. So we already collected $1,100 back in the account. So by selling 10 of them for $130, I got back $1,300. So now, so far, we've collected $2,400 back, and we spent $3,400 to ensure that whole play. So again, remember, we're trying to figure out inverse out to see, hey, that's profit. Are you just making an overall net gain? And that's only because I decided to add premium. So if you think about this, this is the beauty of premium. I did a lot of work, and this goes to show I panicked a little bit. I should have just been, if I was even a little bit more patient at the end of the day, the original strategy worked. If I just waited, I would have just been up $1,000 and I wouldn't have to have dealt with any of this of any of this crap. And I paid commissions. I had to think about it. These were up, but I could have made a lot of money. I was up $3,000 on these calls at one point. When I was down, I got down $3,000 even more on here. But I could have made a lot of money. I didn't choose to sell the insurance like I did with the puts, so I learned on the way down a lot better. But we got that $1,300 back, and then now, remember, I bought this Apple call back. That's the 2020. I bought it back for $535. So I spent $535. How much did I collect? I collected $975. So that's like $430 profit. But so again, that's the difference. Remember, I sold premium on that. I sold it for $900. It dropped to $500. I bought it back, and I kept the $400 difference. So then there's that play, and then that was it. Those were the only puts. So wow, those were the same 165. So that's it. So far, I've collected $2,800 back. So now I've collected $2,800 back. 2830. We did 3420 minus 2830. So far, I have pretty much 590 of risk on the table and contract. So I need to pretty much make 590 back. These are worth 500. So pretty much 590, I'm still negative beyond whatever this play was happening here now too. So now think about it. If I close out this trade today, I would make $1,000. If I closed out this one too, I would make 160, and then again, I would get back $500 here. That would make up the difference here. I'd be down $90, and then I'd get 1,000 profit here. We'd be up pretty much $900 overall net gain. So you see, it says down net 900. We're pretty much up $900 because at the end of the day, that's how much more money has came out even beyond the outlay. So if all of these contracts I bought expired worthless and we closed out every single one of these positions, at the end of all of that transaction, we would have been walking away with $900 in net profit. So that one had a mix of every single thing in here. I went small, a little bit bigger at first. I averaged down, and then we were using the contracts and scaling in and out on the way down. So it was really difficult, but here's the beauty again. If you just waited, you would have made the money on selling premium. So that was a long video. Hopefully this gives you guys insight, but you guys have been watching this play live. We've been talking a lot about selling premium. And again, I think this play that we made here was important, but do you see the whole concept? I'm trying to make it so I can make it have a win-win. So we'll see. Who knows? Hopefully Apple has a crazy rip or Apple gets bought out. No, whatever. But if it does do anything, even in 3 weeks or whatever, we could still make money. If the puts drop, we can make money. But at this point now, we're making money. But I could walk away from all this, say, hey, I'm done with this headache, walk away with $1,000, with a $4,000 max risk on the table. It's like 25%. It took a long time, but then we could move on and go elsewhere. Isn't that crazy? I did that. Took me that long, and I'm already up $500 total on here. And we made that Amazon play this week. So this one was a lot more riskier because it had less time, and I sold 1,000 off the bat. But you guys saw this play started at the beginning of Tuesday till today. I'm up 590, but then I'm down 117 here total. So overall, between both of those, again, if I liquidated and canceled them out right now, I'd close 477. If you want to learn about that play, let me know. I'll make a video, but I'll wrap it up here. Get to your weekend, enjoy it, be safe, study up, go through the videos. Let me know what you guys want me to talk about. Check out the boot camp, the real estate course, the stream alerts. Let's get a meetup. You guys want some philosophy videos? Let's go. All right, guys, I love you. Like the video. Goodbye.